Welcome, everyone. In this session, we're going to talk about our chapter number 2, that is the framework. We don't have much thing in the chapter, and also it is not very important chapter for this course. So we have only maximum 5 marks maybe we can expect from this chapter. So let's have a look what we have in this chapter. So if we go to the chapter overview, the first thing we can see have accounting equation. The accounting equation, almost all of us done in our level 2. So here we have to know asset equal equity plus the liability. That means if I have equity and liability, it will be equal to our asset. In the financial statement, we have a two side. One is asset. That means you have to find the total asset, that is non-current asset, and you have to find the current asset. And if we added these two, that will give us the total asset. And this total asset exactly has to be equal to our equity and liability. Now the equity represent, for example, share capital, share premium, revaluation reserve, and return earnings. All of this is the part of equity. On the other hand, the liability, we have, for example, bank loan, the non-current liability, and we have some current liability as well. That is, for example, trade payable, bank overdraft, and VAT liability, and payroll liability. This sort of thing are current liability. And after that, the total equity and liability and the total asset has to be equal. And that's how we have confirmed the balance sheet is correct. Now, this is the equation that represent the asset equal the liability plus the equity. Then we have accounting standard. Accounting standard to represent how many IS we have. Like for example, every time when we do any recognition for the financial statement, we follow the IS, that is the International Accounting Standard. For example, inventory. For the inventory, we follow IAS2. For example, for the PPE, property, plant, and equipment, we follow IS16. So all this IS is the combination for representing the financial statement, and that's all we run from there. Now, the next one we have IFRS. IFRS is basically the International Financial Reporting Standard. So this is the modification of IS. So for example, if we have one IS, let's say IS2, and in future, if we done any modification with that IS, so we called it IFRS. So IS is kind of like the accounting standard that published by the ISAC. And after that, IFRS is the new standard, the modification of IS that is published by the ISB. So this is just like the information, how does it work, but it is not very important for your exam. In the exam, they'll not ask you what is IS or what if IFRS, but we need to know the recognition criteria. So that means like how we recognize under which IS. Then we have a measurement basis. Measurement basis, we have here how we recognize the asset on the financial statement. We can use the historical cost. Historical cost is the purchase cost. Historical cost is the purchase cost, the price we paid when we actually purchase that asset. Then we have a value in use. Value in use means like if I use this machine or asset rather than sell it, how much will be the value? So for example, if I sell this asset, I can get 500 pound. And if I use this asset, that will give me the value of 700. So always take the higher one. So we always go for the value in use. Current cost is basically how much is the current cost if I like to replace this asset. You can say current cost basically the replacement cost, and the fair value means the market value. Like if I like to sell this asset, how can I sell it for that amount? I'm going to recognize in the financial statement. So this is basically the measurement basis. And top of that, we have some definition. We have some definition of the asset and some accounting concept. For example, relevance, faithful presentation. So all the information on the financial statement has to be relevant for that period. And faithful presentation, here we have to see like only the information we are providing on the financial statement has to be accurate. And there are a few more things that is says enhancing the quality characteristics, the comparability. So financial statement normally present for the 2 years, so with that we can compare this year data with the last year. and the variability, timeliness, understandability. So this is also characteristics of the quantitative data or entity, so that this thing also be considered when we prepare the financial statement. For example, if I prepare the financial statement, it has to be understandable. If I don't understand anything after reading that, that doesn't make any sense. Top of that, we have some element of the financial statement. We have an asset, we have a liability, equity, income, expense. So we're going to look at some definition. What is asset? Asset is something controllable asset that will create some future economic benefit because of the past event. Liability is the obligation. Equity is the part of the owner. So this sort of thing we already know. Income is from the trading. We call it sale. Expense is relevant to the business. Allowable expenses, recognition, asset and liability. So this is mainly like a little bit idea about the characteristics of the financial statement and some definition. All right, let's move to inside of the chapter. So we have here accounting standard. You can see in the accounting standard we have organization, that is IASC. They published the accounting standard, that is IAS. They founded in 1973. And IASB, this is the International Accounting Standard Board. They formed 2001, replaced ISAC. So this one is now replaced with that. And they published the IFRS, adopting existing IS. So if any IS need to be changed or need any modification, the next one will called IFRS. So it is the modification of the IS. The next point we have here, that is some definition, some principle like a going concern, director responsibilities. This thing is not very important, but you need for your knowledge purpose, for your understanding purpose, it's really good to read always all this thing, but it will not come in the exam. Now, duties and the responsibilities of the director. Director have all the responsibility except to enter into any contract, except enter into the contract on behalf of the company. So you really don't have to enter into the contract on behalf of the company, because the limited company will be treated as like a person. Remember that the limited company will be treated like a person. So if we have to make any contract on behalf of the company can use the company name. So the company don't need the director name to enter into any contract. So other than to file the record, submit the information to HMRC, keep the record up to date, everything is the responsibility of the director. So any other responsibility that belongs to director, but not they don't have to enter into any contract, because if the company like to buy any asset or anything, the company can use company name to buy that asset. True and fair view. True and fair view means like the financial statement has to be true and fair. There is two word here, true and fair. The meaning of the true means all the information has to be accurate and it has to be arithmetically corrected. So all the figure we have on the financial statement, it has to be true. And fair means it has to be have a logic, like proper logic. It is fair. So for example, let's say sometimes some information is not is true, but unless you know it is fair or not, it will be very difficult to take the decision. So for example, if we said like if someone do something, and if you ask the reason why you do that, then obviously it's fair. So for example, if you ask someone like, have the company made this donation, and if the company said yes, so it is true, maybe you take the decision based on that, but you need to ask like why. So if when you ask the reason why, and that will give you basically the fairness. Here say financial statement must be sure and true view of the company result for the period and asset and liability at the end of the period. So normally this one is relevant to the audit. The true and fair view is very relevant to the audit, because financial statement always has to be present in true and fair view way. Activity one, duties and responsibilities of the directors, enter into contract. So no, they don't have to enter into contract, as I said. File the financial statement on time, yes. Prepare proper accounting record, yes. Present the financial statement to be audited if applicable, yes. So all this thing is a responsibility of the director except enter into any contract. So we have 2, 3, 4. So you have 2, 3, and 4. So this is the right answer. Director have to do everything except they have to enter into any contract on behalf of the company. Then you have users of the financial statement. So why investor and lender use the financial statement? This is the old topic. Why the investor need to look at our financial statement? Because the investor like to see the performance. Like before I invest to any company, for example, if I like to invest money in Tesco, I like to see like how they are doing, or how is their profit and loss account. So how is their asset situation? So I have to look at that before I take the decision. So I need to look at the performance, and then obviously, like, I need to look at their cash flow and liquidity situation. I need to look at companies expanding, doing good or improving, or declining. So expanding or declining. So for that reason, I need to look at the financial statement, because the company I'm going to invest in, I need to make sure this company is doing good. The lender want to see like they can pay back their money, so pay back the loan, or they want to see like the commitment they will keep, like to pay the interest or something. So they'll be able to pay the interest, pay interest, and the security of the investment. So the bank want to check before they give the money, is the company is able to pay this money back. So for that reason, investor and the lender, they will look at the financial statement. The next thing we have here, this concept, but it's not very important for your this exam. Materiality. Materiality is a concept, is where we have to show like the significance of this amount. Now, materiality is a subjective figure, and it depends on the situation. For example, if a small business, their income is £10,000, for example, a small business, their income is £10,000. For them, £1,000 or maybe £500 could be material, because it is almost like 5% of their income. So it could be more material. But for example, for a company like a Tesco, their income is 10 million. For them, maybe £5,000 is not material, because compared to their business, it is really big. So it depends on the situation. So if represent the significance, there is some rules to find it out, which one is material or not. For example, it has to be like certain percentage of the income or the net asset, but it is not very relevant to your this paper. As I said, it is again is relevant to your audit paper. But materiality is just like to represent like how significant the error or mistake is in the financial statement. So if the financial statement have a not significant amount, not material, then we can still say the financial statement is true, true and fair view, or free from material misstatement, because it is very impossible you say everything is 100% accurate. For that reason, when the auditor give the opinion about the financial statement, they always say like financial statement is a free from material misstatement. They never say like it is free from any mistake. If you look at this example, this big co has a net income 100,000. The company own a building which has destroyed in a fire, and after a lengthy battle with the insurance company, the company reported a loss of 10,000 in respect of the budget. The materiality concept state that their loss immaterial, because the average financial statement user would be concerned with something the way is net percent of the income. So 1% of the income. If it is not be concerned, so they will not be considered as a material if it is less than 1% of the net income. So this is the threshold standard they set up. Materiality concept state that a loss in immaterial, because the average financial statement user would not be concerned with the something that is only 0.1% of the net income. A small co has a net income 500,000. There is another company. A small co also own a building which is destroyed in a fire and report a loss 100,000. So you can see here, so it is less than 1%, less than 0.1%. So it is not material for big company. So it is not for the small company. So you can see here 100 uh, is a loss over 500. So it is like kind of 20%. So it is a big thing, significant for them. So for the small company, it will be material because it's a lot of losses. So material to represent the the significance, like how big it is. And we have some definition of asset, liability, equity, income, expense, and we have some example here. What is asset? It's a present condition, a present economic resources controlled by entity as a result of past event. This is called asset. Remember that if any entity control because of the past event, and if it is create any future economic benefit, we call it asset. The residual interest in the asset of an entity after deducting its liability, we call it equity. So from the asset, if you minus the liability, whatever is remaining, we called it equity. The distribution to shareholder equity claim is an expense. That's false. Remember that the dividend is not an expense. Dividend is paid after the profit. So dividend cannot be expense. All right, so we have other measurement, how we record the entity in the financial statement on what value. So let's have a look. A number of different measurement bases are used in the financial statement. Match which measurement basis with an appropriate example. A company can sell a machine for 9,000. Company can sell a machine for 9,000. Now it is basically our realizable value. We can sell it right now. We can sell it 9,000. I'll say it is our fair value. The company can sell a machine for 9,000. This is the fair value, because if I like to sell this asset now in the market, I can sell it for 9,000. If a company had to buy machine B now, it would pay 20,000. This is basically the replacement cost. So the asset I have, if I like to replace it, or if I want to buy a machine, I have to pay 20,000. This is the current cost. So current cost, if I like to buy this asset now, it will cost me 20,000. Machine C will be used by a company to generate sale. It is expected to generate discount net cash flow 20,000 over the next 5 years. So it is a present value because I'm calculating how much I'm getting out over the 5 years now. 3 years ago, machine D cost company 15,000 is a historical cost. Historical cost. 3 years ago, machine D cost company 15,000. It is a historical cost. So if I still use the purchase cost, we call it historical cost. An asset was purchased 20,000. It is estimated that it will be generate a net cash inflow of 30,000 for the business, and that it can be sold for 25,000. An identical asset can now be purchased for 22,000. So the purchase cost was 20,000, and the inflow is 30,000. This is our present value. We can sold it for this as the market value, and this is the current cost. This is the historical cost purchase. Measure the asset under the historical cost. That means our purchase cost, how much you paid it for, that is 20,000. We'll look at 20,000. Okay, this is the end of the chapter. We don't have much thing in chapter number 2. It's just like a few definitions and a few entities. If you just revise a little bit, everyone will be fine for that, because it's not very important content you have. Chapter number 2 will be very important. Financial statement preparation. It will be very important for our exam. So hopefully we'll do it together, and we'll see how can we do all this adjustment. So see you on the next lesson for the financial statement.